So the 2019 rally stumbling, investor confidence just a little shaken.
Nervousness and uncertainty.
Fragility in the economy.
A dose of reality and adjustments in expectations.
There's no shortage of things for clients to be focused on and worried about.
The government shutdown.
Certainly Brexit is up there.
Trade talks.
China trade war is up there.
Global growth is slowing.
Obviously, we do see growth slowing.
The global growth environment is slowing so much.
Europe is in a bad place.
The European economy is slow to a halt.
It does feel like there are structural problems with the European Union.
The Italian government needs to have a wake-up call.
I think Italy is kind of doomed to fail, and we may see more political crises there.
Germany, Italy, potentially Japan. China can't afford a recession.
File all of those things under things you should have known already. Joining me around the table, Keith Parker, UBS Investment Research US Equity Strategy Head, Marc Chandler, Bannockburn Global Forex Chief Market Strategist, and Brian Nick, Nuveen, Chief Investment Strategist. Brian, allow me to introduce two things that you should know already. China and the United States are this far apart on the key issues. Should have known that already. Growth in Europe isn't going to be very good this year. Should have known that already. Why have we got the pessimism of the last 24 hours?
Some of it might have to do with the fact that the S&P 500 was up 8% in the month of January. So you're pricing out a lot of good news at the end of last year, and you're pricing out a lot of bad news at the beginning of this year. And it seemed like we were sort of whistling past the graveyard on some of these issues that we knew were going to come up in March, like trade, like Brexit, like at the time, the March FOMC meeting, which has now been sort of tabled. But if you're expecting a big deal in this very short time frame between the U.S. and China, you're probably expecting the wrong thing. At the best, we were hoping for is a short deal that kicks the stickier issues down the road, or maybe more likely at this point, just a delay entirely.
Keith, to Brian's point, this tells you a lot more about where we're coming from as opposed to where we are right now.
Yeah, I would agree. I think at the end of last year, you were pricing in some extreme scenarios as it related to growth, trade, and some recession risk. And I think January has been pricing out some of that downside. But again, we get reminders that trade talks aren't going to lead to a resolution immediately, and growth data is still taking time to firm up and potentially turn mid-year.
What do you think, Marc?
I think that it's basically a straw man. That we haven't really gone anyplace this week, and so every time there's a little move in the market, we have to come up with some kind of long-term structural reason for it. When I think it's just mostly noise, trading in the range of the euro, for example, 113, 115. We try to break out either side. We get back into there. S&Ps go a little bit above 2,700. There's some retracement targets up there. 200-day moving average. We hold right there because we're not going anywhere because we don't have enough information yet, I think, to make a decisive move.
Yeah, to your point on a range versus the trend, is that what you would say about the US dollar as well?
Very much so. Right now, I think fading those breakouts, looking for those ranges to remain intact until we get more information. And we won't get that probably until early March.